I have been trading options for a long time, almost decade and a half. And for most of my option trading career, I was trading them in an incorrect manner, always falling for the glamour of the latest option strategy and never really understanding the associated risks with those strategy. Risks that were not shared in the books, or at least not highlighted enough so that a beginner option trader like me could understand the complete picture. In this post, I am going to share all the cons, disadvantages related to some of the popular option trading strategies. Always remember, just because someone has made money using those strategies, it does not guarantee that you will make money using those strategies too. And also, does not mean that those strategies are risk free. In fact, if you don't understand them completely and implement them in an incorrect manner, it can cause tremendous damage to your trading account and your confidence in yourself as a full-time trader. So what is the real problem here? This is especially true for beginners. Most of the times, the way we face the problems or challenges that we come across is based on our own level of experience and understanding. And that simply may not be enough all the time. Now, when it comes to option strategies, they are complex by definition, and beginner traders will usually focus on that part of the strategy that supports their market view at that point in time. Let's look at an example. A newbie decided to trade options. He, fortunately or unfortunately, was in a roaring bull market. Everything that he touched went up. He started buying options, worked for a while, but then he soon realized that if market did not move within the time for the expiry of that option, he ended up losing money. And that is when he decided to explore the fantastic world of option strategies. Soon he settled on a strategy called as a covered call, where if the markets went up, he made the money, and if they just stayed sideways, he would either make a small amount of money or ended up break even by eating up all the call premiums. Now, while he was making good money when the markets were going up or staying sideways, he quickly forgot what would happen if the markets tanked. Now you might say that it's very obvious, Dean, what will happen if markets tanked and you had a covered call position in the markets. But not everyone has the same level of understanding. Not everyone can understand the payoff diagrams equally well. And especially this guy did not have that clear an understanding of all these option strategies. Now one fine day, he saw that instead of going up or staying sideways, market was coming down a little. In the beginning, everything was fine because whatever losses were happening on the stock were covered by the short option. But suddenly, the fall started to accelerate. And before he could complete some back of the envelope calculations to find out his break even, market fell sharply and it was showing him a big loss. Now he was in utter panic, but he found that market slowly started to recover and finally, recovered a little bit by the time the markets closed, and his loss was a little bit less. And he said, okay, markets may be reversing since it's an uptrend, so let us hold on to this position and come back tomorrow. Unfortunately, the next day, market gapped down by a lot. And because he had this leveraged position in his account, he lost 25% of his trading capital. Now, this came as a big shock to that trader, and that drove him deep down into the process of understanding all these option strategies and what option trading is all about. Over the next decade or so, he kept improving and decided that he will not act unless he understands the things completely. That does not mean he did not make any mistakes after that, but those mistakes were never as debilitating as the one that he made and lost almost quarter of his trading capital in just one trade. So what should a beginner options trader do? Well, you should do the same thing that any trader would do after incurring a big loss. Before you put on your hard-earned money on the line, you should dive deep into these strategies and learn everything there is to learn about them. especially the risk part. Today, I am going to share my learnings of these option strategies over almost a decade and a half of trading, especially the cons or the disadvantages associated with some of the popular trading strategies. Now, even if you just keep these cons or these disadvantages in mind when you are going to place your next options trade, you will be in a much better position than someone who is just blindly following these masters of the universe kind of mentors and options traders. Let us start with the most popular option strategy at the moment, option selling. Let me correct myself, naked option selling. Now, this particular strategy was all the rage some time back before SEBI and the NSE tightened, the margin requirements. The rules were already there, but they were not being enforced in the correct manner. That is all what SEBI and NSE did by actually implementing the margin requirements that they have already shared with the exchanges. And that has reined in the misbehavior of many unscrupulous brokers big time. Here are some of the disadvantages that are related to naked option selling. First and foremost, there is simply unlimited risk in that trade. But you know that already, right? Selling options, you have unlimited risk. The second point is that this particular strategy is adversely exposed to the Black Swan event. Now, if you want to learn more about the Black Swan event, I'll link a video in the description where you will find all you need to know about a Black Swan event. Now, the third problem is, should something go wrong, it is extremely difficult to manage this strategy of selling naked options. Fourth is that if you stay sufficiently away from the current market price, you will keep making small amount of profits for a long time until you find yourself on the wrong side of a Black Swan event. The fifth reason is that it has now become extremely capital intensive. Earlier, the brokers were flouting the margin requirements, the margin norms that were set by the SEBI and the exchanges, and that is why some traders were getting indiscriminate margins to sell options. Not anymore. The second strategy that we are going to discuss here is pretty similar to selling naked options, and it is constructed by selling naked options, both calls and puts, and it is called as the at the money straddle. And nowadays there are many Twitter people posting and suggesting this strategy to everyone. They are posting, corresponding big mark to market screenshots and promising big returns by using this strategy. But you should understand that this strategy is quite similar to walking through a minefield blindfolded. Why? Let us look at some of the reasons. Now, this strategy carries double the risk of just selling either a naked call or a put. Second point that is very wrong with this particular strategy is that you are selling an at the money straddle very close to the current market price. The closer you stay to the current market price with a short option trade which is not hedged, you are closer to the disaster than you think. Thirdly, should your strategy go wrong, you will need superhuman skills to manage these trades. The professionals find it difficult. Forget about beginners or retail traders like you and me. Fourth thing that I often come across related to this at the money option straddle is that the short call is not hedged by the short put and vice versa. If you believe that you have both short calls and puts and they are hedging each other, that is probably the stupidest mistake you can ever make in your option trading career. Finally, especially during volatile markets, you will definitely get higher premiums on account of higher volatility, but still it becomes really difficult to manage these positions in highly volatile markets. Let us look at the next strategy on the list, and that is covered calls on index. And we just saw at the beginning of this video the painful experience of a beginner trader with these covered calls. Now I will just add a few more points to the list. First is obviously there is no downside protection in a covered call trade. Secondly, the short call is in no way a hedge to your long futures or long index or long stock position. Drill this into your head. Trading a covered call is like trading naked futures with limited upside. Does it sound as lucrative and as attractive when I put it this way? Thirdly, you will be charged heavy margin because buying a future and selling a call both will attract huge margins given the current strict implementation of margin rules by SEBI and NSE. Technically, there will be some leeway, but that is not enough. The margins are still very high. And fourthly, there are many more strategies, much better strategies to capture the essence of this mildly bullish market scenario, which this strategy is particularly aimed at. Let us now look at the next strategy, that is ratio spreads. Again, this is quite similar to the covered call trade that we saw, just in reverse. In covered call, there is unlimited downside risk. In case of a ratio spread, especially if you are putting on a bullish ratio spread, your downsides are protected, but your upsides carry unlimited risk. Now, I have seen some of the traders use this kind of a trade very, very intelligently, but again, they were not in any way beginners or amateur option traders. Let us look at some of the pertinent points related to the ratio spreads. Firstly, this strategy is not 100% hedge strategy. You keep some short calls or short puts unhedged. Second, you need to have good market understanding, good understanding of options to implement this strategy successfully. Remember, you are not going to become an expert option trader by just reading about this strategy in a book or attending a 3-day seminar. Thirdly, the margin requirement will be higher because there will be a few unhedged short option positions. And finally, during volatile market conditions, what usually happens is you are scared by the market and you tend to adjust these strategies exactly at the wrong time, and basically you will end up compounding your loss if you do not manage these trades properly. And in volatile markets, trust me when I say that these are some of the most difficult strategies to manage. Let us look at the next strategy in the list, which is one of my favorite strategies, and that is credit spreads. Now, these are innocuous little strategies that look very, very good on paper. With the recent changes to margin requirements by SEBI, if you are using 100% hedge strategies, these are well within the grasp of retail traders, people with less capital in their account. An illusion of steady income will bring most of the retail traders to this strategy. But trust me, if you don't understand what you are doing and you apply these strategies at the wrong time, it can cause some serious damage to your trading account. Let us look at some of the important points related to this strategy. And the first one is the profits are very less as compared to the amount of loss you can incur on this strategy. Now, this in itself is not a problem, but if you apply these strategies at the wrong time, even a small pullback can show you big M2M losses. Another important point is that you have to select strikes that are far away from the current market price to be safe in your trade. But the farther you go from the current market price, the lower the option premiums will be, and that will hamper the overall profitability of these kinds of trades. And to compensate for this, traders invariably come closer to the current market price, and that is where there is a big chance of incurring a huge loss should you get exposed to a black swan event in an incorrect manner. Let us look at the next strategy in the list, which I seldom use but is probably the most favorite for all retail traders, and that is debit spreads. Now, these strategies are often selected by traders for the exact opposite reasons for selecting a credit spread. A debit spread will usually have a small loss with a corresponding possibility of making big profits. So, the promise of making big money by risking a small amount attracts all the retail traders to this strategy. But as always, as with markets and as with life, there is no free lunch. The first point is that the profit in a trade is maximized when the distance between your long option and your short option is maximum. But the larger distance you keep between these two option trades, the bigger market movement is required for your trade to become successful. Basically, this strategy has a similar disadvantages of buying a naked option. You need a big move out of the market to make this trade a success. Not all market situations are suitable for this particular strategy. You have to be extremely selective when using debit spreads in your trading. But as with all retail traders, there is a compulsive behavior to trade each and every market move, each and every market situation, and that puts retail traders in bit of a problem when they are selecting this strategy. So while debit spreads definitely have the possibility to give your trading account that boost of profits, applied in an incorrect manner, it can lead to a string of losses in your account. After looking at all these cons related to popular option strategies, you may ask, should a beginner stop trading options altogether? And I would say, absolutely not. The purpose of this post is not to discourage you from trading options, but to make you aware of all the cons and disadvantages and unexpected outcomes that you can encounter when you're using these option strategies. If you try to keep these disadvantages, these cons in your mind when you're trying to apply these strategies, or find a way to overcome these disadvantages, then you have a winner on your hand. Now, some may argue that you are only sharing the disadvantages of these option trades, but I want you to start thinking for yourself. If I give you everything, it might prevent you from flexing your mind muscle, and you may discount everything that I ever share with you. But if you spend a few hours scratching your brains trying to find a way to overcome these cons related to option trading, you might make some real progress. But that does not mean that you cannot ask me questions regarding the points that I have made in this video. You can easily put them in the comments below and I will give you a reply as soon as possible. So I hope you like this video. Thank you for watching this video till the end, and I'll see you in the next one.